Welcome back, everybody, to this episode of the Open Concept Podcast, where we are breaking down those unnecessary walls and barriers that stand in the way of greatness. Joining us today, all the way from South Florida, to talk to us about the power of real estate investing, multifamily investing, Natasha Falcone, everybody. Thank you so much for being here.
So much for having me. I'm looking forward to our conversation.
Awesome. Well, for people that aren't listening, you're the founder of Falcone Capital. I've been loving what you've been putting out on social media, not just on the investing side that I'm really interested in talking about, but also on the educational side. I've watched a few of the clips of talks that you've been giving, and you seem really, really passionate about teaching people the power of the vehicle that real estate investing can really drive and make a difference in their lives. And I'm excited to talk to you about it today. But for those that don't know who you are, tell us a little bit about yourself. What's going on?
Well, again, thanks for having me. I'm Natasha Falcone, and I founded my company to invest in multifamily real estate after a long journey of working in the corporate world and working for others. So I learned about real estate in my first job as a tax accountant. And I was placed in the real estate tax department, and they said, okay, this is what you're going to do. And I'm like, wait a minute, this is like people actually own these types of assets? And slowly I started learning about many things, tax planning, the benefits that real estate gives you in tax planning, and everything that goes with it. I went into the corporate world to work for a real estate company, developer, owners, shopping centers, an array of different asset classes. And I spent 18 years of my career there. And I realized there that I was an entrepreneur because I was running someone else's company, but I wasn't an entrepreneur for myself or my family. And that is when, in 2019, I started my own company and began investing in multifamily properties. So I decided to go with that asset class. As people ask, there's so many different asset classes. Why multifamily?
Yeah, of course.
Well, I wanted to invest in areas where I can make an impact and where I can improve properties for the working class. So I buy B and C class, and what that means is I buy properties that are that need some love, that need some renovation, that need to be repositioned and make them nicer, with the objective of keeping the residents from the community there. So that's the goal. And so they've been doing it since then, and slowly acquiring assets throughout the area.
So this is a lot about, like, you're talking about, maybe there's a small apartment building or complex, and it's maybe a bit run down, but you're purchasing that, and you're then renovating the rooms with the idea that you're going to be elevating the space, elevating the community, but then still having a place where those folks can go and either rent the units, but there really isn't going to be a huge negative impact in the community, because developers in general get sort of a bit of a bad rap when they're building new units. But I think people really can appreciate how much goes into taking a unit that's already existing and really starting to elevate that space.
Yeah, there's a big difference, because many times, our buildings are garden style buildings. Yep. And when something is renovated, it changes from B and C typically to an A class building. with a great deal of amenities and
Mm,
other things. Beautiful buildings, but just catering to a different clientele, as opposed to the buildings that I renovate. There are not many amenities, but the way we compensate for the lack of amenities is just, beautiful landscaping and ensuring that the inside of their unit, the outside, the paint and everything else, but making sure that the inside of their units could be just as nice or very close to being in a beautiful A-class building, in the sense of, like, we do put in, nice white cabinets. We clean them up very nicely. We renovate the bathrooms with the idea that people don't need to live in dilapidated spaces just because they live in potentially B class
mm.
buildings.
For people
That's
that are,
really the goal.
I love that. And for people that are listening, maybe they're unfamiliar with what you would consider like a B class, C class versus what an A class might look like. Can you break that down for us a little bit and discuss maybe some of the qualities or nuances that a C class or B class building might have, and then what it really takes to have it be defined as an A class?
Yeah, an A-class building basically has all of the amenities. Many times they're high rises. And when I say amenities, there's gyms and pools and sometimes movie theaters and parking garages and valet and things of that nature. Now, there's not every building's the same, so there's a range of what that means, but those are the things. And in a B class asset, it's mostly a garden style building, maybe 2 to 4 stories, sometimes 1 story, open catwalk buildings where there are typically no amenities. And so the beautification of those buildings has to do with maintenance on the outside and landscaping. And so because there are no amenities in the B and C class, the rental rates are able to be lower than if you were in an A class building.
Mm,
So
that
that
makes
makes
it
a
yeah,
big difference as well.
makes a ton of sense. So getting your start in the tax world, right? Understanding that you're seeing these units that and these assets that are coming through, and how you're organizing them and setting them up for whether it's going to be tax write-offs or different strategies that people can use. Probably give you like a really good insight as to the power of this class of asset, and really the leverage that you can use to start building real wealth, like real generational wealth.
Oh, there's no question. And one thing that's very true that I love to always mention is that you can invest in real estate and still do something else.
Mm-hmm.
Meaning, you can do what you love, whatever it may be, whatever business that you may be, but you can invest in real estate too, because you don't have to be an active participant. Meaning, you can invest passively. I mean, even when you invest passively, and that's another part of the conversation, even though when you invest passively, you still have to have an active role in your investments,
Mm-hmm.
but it's very different than being the active operator of the day-to-day business, dealing with the tenants and dealing with the day-to-day and dealing with the lending and dealing with all of the issues or the steps that come with owning real estate. So yes, what I learned is that you could do both, and and you get the advantages in the same way, whether you invest passively or actively. So it was a big eye opener for me. Um, Being first generation American, I didn't have anyone telling me that I could be an entrepreneur. I didn't have anyone explaining that we could own real estate, and that is basically how I figured it out.
People would say, I love the idea of real estate, and buying a building, that sounds kind of crazy. Like that's for everybody else. That's not for me. That's a dream far too out of reach. But if somebody did come and approach you, and they had that belief and they had that understanding of, this is something for maybe something for Natasha, or this is maybe something for the Grant Cardones of the world, but it's not going to be for me because I don't see that path forward. It's a pipe dream. It's not going to be possible. What would you lean into, and what would you encourage those people to start to learn? What would you start to say to them?
I would say, number one, it is absolutely possible, because I started at zero and was able to continue to build, and I'm not special, and other people have done the same thing. I would say investigate and figure out what asset class you like. And you can do that in many ways. You can watch podcasts. You can listen to conversations like the one that we're having. You can watch YouTube videos. There's so much that you can do to just learn. And my suggestion would be, because many think one big objection is, well, I don't have millions of dollars to invest. Well, the great news is you don't need it. You can invest passively is a great way. And that is how you start learning. So if you want to invest in a multifamily building, but you want to keep doing what you're doing, that's how you can do it. And then you can learn. You can learn from the operator. You can see how the reports are. You can start watching how someone else does it. And then you can get involved, and then you can start figuring out your path so you can do it. And you don't have to start off by buying a 100-unit building. You can buy a 6-plex. You can buy an 8-unit. There's a lot of ways to get involved in real estate. And it's important to do that research to figure it out.
Why did you specifically go down the route of multifamily? Because there's a lot of other areas that you can of real estate that you can start investing in, whether it's going to be single family, just buying single family homes, renting those out. You can buy, a few apartment buildings, commercial real estate. There's lots of real estate asset classes, right? Warehouses, storage units, all that stuff. Right? Some people love certain avenues and they stick with it. But why specifically did you get into multifamily and looking at whole buildings? Because that can be an intimidating thing for a lot of people, right? Rather than just buying a single door or a single house, you're in fact buying multiple doors and multiple units at the same time. Why did you decide to go down that path versus anywhere else?
So my experience was in the shopping center world and some residential, meaning apartment buildings. And when I started my business, that I wasn't sure. I knew I was going to invest in real estate. I wasn't sure what asset class I was going to get involved in. And I do not believe there is a bad asset class. That I'll start by saying that. Every asset class has its moments and has its peaks and valleys, but they're all good. If you look historically, they've all been fabulous at some point, and then they go bad, and then they good. So I don't believe there's a bad asset class, but I believe you need to pick the asset class that you really believe in and that you're passionate about. So I chose multifamily because I really wanted to make a difference in communities. And the communities I invest in is where I lived, where I was a child. So I am very familiar what it is to live in the buildings that I buy before I renovate them. And so I felt that I was very called to do that and see a building that looked similar to where I lived, where if something needed to be repaired, my mother had to pay for it because no one was coming to fix it.
Yeah.
And change that script and change that narrative and create a situation where we treated the buildings with a lot of respect, with a lot of love, and treated our residents with just great deal of respect. That is how, and so that is kind of that was what drove me to say, I'm going to go back there and I'm going to start doing.
Real quick before we get back to the show, if you have heard anything on this podcast that has resonated with you, or if it's helped you in any way, appreciate more than anything in the world if you could go hit that subscribe button or leave us a review. It helps us tremendously. I want to go back to being able to continue to serve and do more and more and help out and get bigger and bigger guests on, better and better. The only way that I can do that is with your help. I'm so honored to be here. Let's get back to the show. Appreciate you. Have a wonderful day.
And then I started in that community and then started expanding to other areas that were very similar to where I began, I guess, my journey in life.
You mentioned you're first generation American, so
Yeah.
new. Generally, like you're early new to the country. You don't have a huge family history in the country. Where were you from originally?
I was born in New York, so I was born here,
Yeah,
but my parents are Cuban. So I'm
um,
Cuban American.
yeah. And that when they moved to America, when? Just out of curiosity.
Oh, before they moved in the 60s, right when
Okay.
everything started happening.
Yeah. Yeah. Right on. Um,
Yeah.
that's that's fun, and I think someone might ask, what should my first deal look like? Like I'm really liking what Nat's dropping here. I'm really interested in my first deal. I don't know how to analyze it. I'm looking at lots of opportunities. I'm kind of getting nervous to pull the trigger because they all seem kind of good. They all seem kind of bad. Maybe timing doesn't feel right. And they just like get very close to maybe pulling the trigger, but are just pulling back a little bit because they're nervous, right? And nobody knows how an investment necessarily is going to turn out when when they put real money on an investment, whether it's going to be a home or whether it's going to be in a stock or whether it's going to be um, in any sort of other investment, crypto, into investing into yourself, right? You don't know necessarily what you're going to get out of that. But somebody that's maybe nervous and they are thinking about pulling the trigger, but they're saying maybe now's not the right time. My neighbor's telling me this is a bad time to do it. There's some uncertainty in the world going on right now. What would you tell that person?
You know what's interesting? No one is nervous about investing in the stock market,
Hmm.
but you hear a lot of nervousness about investing in real estate. And the way I see it, and I'm not against investing in the stock market, I believe in diversifying, but someone else controls the, when you invest in a stock, someone else is controlling what happens with that stock. When you invest in real estate, and there's a lot of things that have to happen before you invest, and we'll get into that in a second, you control. You control what the asset is like. You control whether how quickly you have a tenant in there or not. And yes, there are outside factors that come into play, and that's where the due diligence really has to be really well done. We jump to invest in other things without a great deal of due diligence, but in real estate, we get scared and then we don't do the due diligence where it's could all be really right in front of you. And so, what would I say to someone? I would say, start asking for OMs, and that is an offering memorandum. So you can go out and ask someone like, listen, I'm really looking to invest, and can I have let me take a look at the offering memorandum. Start asking questions. Start understanding what those things look like. And so that you know what it is that matters to you. Because you have to understand for yourself. Are you looking for appreciation? Because you don't need the cash flow right now. Do you need the returns and you're depending on investing that money for a return on your investment? Like, where do you stand on those things? And that's what makes a deal for you or not. I don't believe there's a bad time to invest in real estate. I don't know if you've heard, don't wait to this saying, don't wait to invest in real estate, invest in real estate and wait.
Yeah.
So there's not a bad time. You just have to make sure that you're making good decisions.
Yeah. No, I saw a post that you had made, and it was on the hills that you would die on for
Yeah.
real estate. I don't know if you remember this. I might be going back a ways here, but one of the things that
Yeah.
you had said was because you mentioned appreciation, but essentially cash flow always wins in your mind. Cash flow is important. Appreciation is going to be secondary. Why do you say that?
I believe that when you buy an asset, so many times when I buy a property, it's maybe very cash flow light because many times the rent is low because the apartments are not renovated. But if when you do the work, I believe that the property needs to cash flow because you don't invest in something and then put all of this energy into it and then not have cash flow. So cash flow first, but appreciation second. And that's where you want to do research on the market that you invest in. So I invest in the Miami market, in South Florida, but specifically like the greater Miami area. Historically, multifamily properties in this market do not go down in value. You can make mistakes. You can over leverage. You can over improve. There are a lot of things that can happen. But in general, done right, the asset class does not go down in value. And so the appreciation is going to be there. That's not true for every market. So you want to, going back to what we were speaking about before, you want to really understand what's going on, where you're going to invest, to make sure that that's part of the mix of what your returns are going to be in the back end of the asset when you either sell or liquidate or whatever it is that you're going to do.
And you're right. I love what you said about not every asset class has that same, or every location has that same stability, that same growth, right? Because many more neighborhoods, avenues, cities, they do fluctuate a lot in value. And much like the stock market, that can start to really get people worried. But traditionally, looking for a market that is going to be relatively stable is going to be it's going to de-risk the assessment and certainly de-risk any sort of mindset that you have about putting your real money where that goes. And even if it's cash flowing reasonably well, but there's that risk that it could really depreciate or really appreciate over time, is a kind of a nasty place to be for a lot of people if your tolerance for risk is relatively low. But if you know if it's going to steadily cash flow, maybe not necessarily a lot, but enough to self-produce, enough to reinvest into the building if issues come up. But finding a neighborhood that has relatively stable climbs of value year over year, over 10 years, 20 years, 30 years, 40 years, 50 years, historically, is a relatively safe bet. Is that what you're getting at?
Yes, but mostly know the neighborhood, understand it, or make sure that you're investing with an operator that is seated in that neighborhood and really understands it. Because you can take a snapshot of a picture in time and say, oh my gosh, this neighborhood is booming, and you're looking at 2 years of activity, and you're not looking at what happened before, or you're not paying attention to what's coming ahead, where everyone might be leaving to the other side of the highway. So you really need to understand the neighborhood and also understand the metrics of the deal, because something, and this happened a few years ago when rates were very low, something could cash flow wonderfully. But if your rates are at 2 and 3%, and now you have to refinance because your loan is maturing and your rate is now at 6 or 7, is it still cash flowing? Those are all questions to ask, because it's not wrong for a rate to be higher. You just have to understand the underwriting.
Yeah,
and make sure that you can ride that time frame.
We saw that here locally where we are a handful of years ago, right? Interest rates were really, really low. Banks were loaning money. People had a lot of equity in their homes. And so they ended up where they would refinance, they would put money into their home to build or to upgrade or buy the things. They're using their home equity line of credit and the equity that they have in their home. And all of a sudden those rates drop from rise from 2% to 3%. All of a sudden their monthly payments go up huge, and now they can't afford their mortgage anymore. They can't afford the things that they bought because they couldn't predict the interest rates. Nobody really could, but they really got caught off guard. So what sort of when you're looking at a deal and you're looking at a pro forma similar to this, is there a rule of thumb that you typically look for as far as if the rate is this, it's cash flowing this? If we know it has a 3% tolerance rate or 4% tolerance rate, what needs to be true to make this a sound investment? Or what do people typically get wrong when it comes to not performing their due diligence?
I believe something that happened that many people got wrong was having very low floating rates, because the rates were so low if you were floating that not everyone, but many were securing floating rates. And then when rates jumped from 2.5, 3 to 9 because of what their negotiated rate was, then there was a problem. So that's when the property is now upside down on its cash flow. And that brings a whole other set of issues, especially if you're syndicating and you have limited partners and what have you. I am a believer of conservatively, I believe in fixing the rate. I don't believe in floating rates, because I believe there's a responsibility to know it's interesting because I fixed all my rates during those time frames, and everyone thought I was crazy because I was paying probably 3 points more than everyone else was, that many other people that I was speaking to. But then everything that occurred happened, and then now my rates are fabulous. Now the rates are good. And it wasn't because I had a crystal ball. It was strictly because I believe in conservative, and financing specifically being conservative and making sure that you can run a time frame. Typically commercial loans can, depending on could be anywhere 5 to 10 years, depending on whether it's what it is you're doing. So I figured between 5 and 10 years, I have this fixed. I know what I have to perform. So if rents soften, then I still have, I know what I can underwrite to, as opposed to saying that, oh my gosh, our rates are so great, and acting as if this is going to be forever. And that's another tip for your listeners. If you're looking to invest in real estate, things always shift. There's always a 5 to 7 year shift of some sort. We can't predict what it's going to be. What happened last were interest rates. Well, make sure that there's something in place, some levers in place to mitigate as best as possible, because nothing is perfect, as best as possible to mitigate any downside that may happen.
Yeah, I love everything that you're saying right now. I appreciate what you said about really knowing your neighborhoods too. And I think that that's a part that people overlook a lot, right? Like they see investments in cities that it may look good on paper, but they don't really know the neighborhood. They don't really know the nuances or the micro, political parties that are involved. They don't know, they don't know what sort of development is going in down the street that could potentially devalue the building that they're looking at or the real estate that they're looking at. And I think people really start to get excited about deals on paper, and they jump pretty quickly. They think that this is an opportunity. They've heard of somebody else maybe investing in another area, so they think that they should do it. And they've kind of, heard that friend of a friend that's been investing, but they get caught off guard because they don't truly understand their neighborhood. And you're not investing when you're buying a building. You're not just investing in the building itself. That investment, the upside of that investment or the downside of that investment, is wildly predicated on the stability of the neighborhood, the potential gentrification of the neighborhood, the potential downside or destruction of a neighborhood if it's kind of moving in a different direction. But I think that's something that's really overlooked. Would you agree?
Yes, that's why if you're investing with someone, like if you're investing passively, make sure that the operator really understands what's happening, because you could buy a property. An example of what you're saying, you can buy a property. It has the grocery store, it has all of and then all of a sudden you find out that the grocery store's lease is up and they're building a new building on the other side of town. Well, what's going to happen? All the commercial infrastructure is moving somewhere else. Well, it all depends on where it is. Like in Miami, there's nowhere to go. So it's a little different. But if you're going somewhere else, and if you're going in the middle of the country, then it's a different scenario. So make sure that your the operator of the property, if you're not an active investor, make sure that they really know what they're doing, in the sense of that they do understand the market, that they do or that they have a game plan of
Yeah.
how they're going to mitigate any issues. Like a multifamily property is, devalued because there's vacancy, because it's all based on income, as opposed to when you buy a house, and the pricing of single family homes is emotional. Because if you and I live next to each other and you decide you want to leave and you cut your price dramatically, that's the new value of my house.
Yeah, very true.
If you own a multifamily building and you have, let's say, 10 people paying you rent, the rent is what's going to dictate what the value of the property is.
Yeah.
So that's how it's, a little different, and how important it is to understand how the operator works.
We'll come back to that in a second, but I want to talk about the difference between active investing and passive investing, because we've talked about this a few times. The comment has come up, and so I just want to make it very clear for everybody. When you're referring to active investing versus passive investing, active investing, you're referring to we're putting money in and we're actually operating as a general partner. We're running the business, we're running the building, we're acting as the landlord, we're collecting rents, we're doing the updates. But as a passive investor, you're just a financial partner, and you have an operator that you're working with, but you're investing a bit of money into a larger project overall. Is there any other nuances to that?
Yes, I think you described it perfectly. An active investor is the one that's dealing with the day-to-day on all aspects of the property. And then the passive investor is the one that believes in that they should, because I'm a big believer of operator first, asset second. So the person invests in that building with that operator and basically believes that operator is going to perform the way that they said for a return. And the expectation of the passive investor should be to receive quarterly reports, to have information, to have access to that active investor, the operator, if you will, so that they can understand how their investment is doing.
And I think that's a really important interpretation, right? You're investing in the operator first and the asset second. So you're investing in the person that you believe is going to generate either the most revenue or the most liquid cash, or really drive the asset to the best of its ability. So you're really investing in that person first and the asset second. If somebody was going to be investing into a person, into a good operator, what would somebody be looking for in a person? Is it simply just track record? But if somebody's going to be giving you hey, Natasha, here's I have a bunch of money, I'm looking at investing in you as an operator. I also have another friend that's doing this over here. What would you tell that person to look for in a great operator, somebody that is worth investing in? Because arguably, there's a lot of buildings worth investing in, but if you're doing business with the wrong person, that's going to tank the deal pretty quick.
That's right. A bad operator with a good asset could go wrong. And a good operator with a bad asset, or something that goes bad because it's an investment just like any, you have a better chance of recovery, fixing, whatever it is, depending on what the issue is. So what questions would I ask? First question is one question, and they're not in any order of priority, but do you know the area and have you invested there before? And what have you done, and what has gone very well and what has gone bad? I would ask for recommendations from other investors. Ask for references. A great one is, I'd like to talk to somebody that invested with you that no longer invests with you.
That is a good one. And why?
Because that doesn't mean it's a bad relationship. It could be that the asset was sold. It could be anything, but that person's no longer. So that's a great one. I would also want to understand their offering memorandum, maybe a previous offering memorandum, and talk it through, or the offering memorandum that we're talking about, because for the investment, and deep dive into it with a lot of questions in reference to the asset. And I'd want to get a good understanding that the person operating day to day understands the location, understands the asset, and I would want to understand the team, because many times you hear that there are many people involved, and potentially the person that you're talking to may not have even visited the asset. So who are the boots on the ground that's actually going to, and I'm not talking about the person that's going to go do the actual renovation. I'm saying who's managing the deal from an asset management perspective, who's there understanding what's going on, who's really watching the store, if you will.
Yeah. I got to ask, what was the first deal that you ever did that got you like really kicked off and excited into the world of multifamily investing?
The first deal that I did was an 8-unit building in an area in North Beach, which is a section of Miami Beach, which many people are familiar with. And I bought that property because I met a broker at a networking luncheon, and I mentioned to her, I'm looking for multifamily. I wasn't 100% sure what area I wanted to be in yet, because I hadn't honed it into what I mentioned to you about the neighborhood that I grew up in. But I said, I want to buy something that I can renovate. I want to buy something that, where I can make an impact. That I knew I wanted. So she says, oh my gosh, I'm going to have this listing. And I went and I saw it, and I looked at it, and I said, I can't, I don't invest in Miami Beach. So I come home. This is what I said to myself.
This is what you said to yourself. Yeah.
Yeah. I come home, and my husband says to me, since when? Like, how is it that what do you mean you don't invest there? Let's go back and look at it. So we went back. The numbers were great, but I was like, no, this is not where I want to invest. And he's like, I don't understand you. And he goes, would you just buy the building? And thanks to him, I took that next step, because it was fear of the first building that I was buying that I guess that's what was driving me to say, oh no, I don't invest here. Well, it's one of my best performing assets. And fast forward to about 3 years later, I was able to buy the asset right next door as well. And I love that market, and it is very similar, working class families to with the neighborhoods where I grew up.
Yeah. That's a great story. I love the fact that it's not very often you have the husband say, yeah, why don't you just go buy the building? Just buy the building.
He's like, what are you doing? Like, what do you mean? What do you buy? What are you talking about? Like,
I don't invest in Miami Beach. Well, where do you invest then?
That was exactly his point. He goes, go buy the building. I promise you, he goes to me, if you think it's underwriting, I promise you it's a good deal. If you believe in what's on the paper, I promise you it's a big deal. I'm like, okay, well, let's go. And that's what I did. And here we are.
Love it.
Yeah.
One of side note here, we'll get back in a second, but it's sort of a fun story because it ties into what you were saying, the single family world. And if you decide that you want to sell a home really quickly at a low price, then your neighbor's house automatically gets compared to that valuation as well. One of the second deals that I ever did, it was a single unit condo, and I was it was a rental property that I was purchasing, and it was an older building, and there was a gentleman in there, and I knew he had owned about a dozen of the units, and so he had listed the units, and I think he was asking $210,000. And to give you a perspective, like those deals, they don't exist here in this area anymore. This was going back 18 years ago now, or 19 years ago, something like that. So really inexpensive. But at the time, I didn't have any money, but I knew that he had owned a bunch of units, and so had worked out a deal where I made a lowball offer on it, and I knew that he wanted to get rid of these units, and he was open to selling them. He didn't really want to hold on to them. I'd heard through a realtor friend, and so I made him a lowball offer, and I grinded him, and finally he agreed. But I said, look, this is what we're going to do. And that, like, the thing that landed me the deal is, I said, we're going to do a handshake deal. Like, this is going to be the sell price that you're going to sell it to me for. But on paper, we're going to say that it's worth $30,000 more than it is. We agreed on it was going to end up actually being $10,000 more on paper, so that he held the value of the other units higher. But at the time of the deal, the agreement was he was going to write me a check for a renovation credit. So it kept the valuation of his existing properties higher. So he wasn't selling an individual unit. And at the time, I only had to put 5% down. So I took out a loan from the bank on a line of credit. I wrote him a check, transferred really quickly, closed as quickly as possible before 30 days. I think we closed in like less than 20 days. It was a quick close. It was a building that wasn't there. And then he wrote me a check. I put that money back into my line of credit, and essentially got that unit for zero down, because it was just like a really quick transfer of money. But the key piece there was, we had agreed on a price, but he didn't want to devalue the other units potentially setting up to sell. So on paper, we kept that price higher, and in the background, we worked out an agreement.
That's excellent. That's great that he did that.
Yeah, no, it was a fun story. That was my sort of second purchase in real estate, but that was always a fun story. I'll always remember that. For those that you talk about, people talk about zero down, right? Buying buildings with other people's money. There's a lot of that going on online. A lot of great people. Pace Morby. I'll drop his name. He's I don't know if you're familiar with his stuff, but he's a great example. Invest in multifamily. Use other people's money. Don't use your own money. And for somebody that's hearing that, and they're thinking, I want to invest with other people's money. I don't have money of my own to invest, but I know that this is possible. I just don't really understand how to make that happen. Do you have an experience with that? Like, what would you tell somebody if they wanted to go down that rabbit hole of starting to invest with other people's money, whether it's them brokering the deal? How do people going about doing that?
I do not subscribe to that philosophy, because I believe that if somebody is going to invest alongside you, that you need to have much skin in the game too.
Yeah.
So if I'm operating a deal and I don't have any money in the deal, and I have investors that are investing with me, I just don't see how you gain the trust of when you have nothing at stake.
Yeah.
So that is my philosophy. Now, I don't understand how people invest with other people's money. People have been very successful at doing it with no money down. I haven't figured that out yet in the multifamily world, so I really don't know. I have seen, and I have done seller financing, but you still need money because you don't get 100% financing typically. Correct. But other people do it. So I will say I can't comment on how that happens, but I believe that an important part is making sure that the person that you're investing with is investing in the deal too. So that's one thing. Now, with someone wanting to get started, there is no question that there are, for example, brokers that put two people together and then they put their fee in the deal. So then now that's how you can actually be a part of an opportunity if you're brokering a deal and you're making a commission and you put your money in the deal, which I think is the smartest thing to do, because you're going to get cash for a deal, but here you get the cash you invested and you get the benefit of the appreciation. So I don't have a good answer for the other people's money.
Well, it's a great philosophical answer because
Hmm.
it's and I believe that there's a lot of people that feel the same way that you do when it comes to investing. It's if you don't have skin in the game and something goes wrong, you're not going to fight like hell to make it right because you're not fully invested. And so you do in a lot of ways want people that really are invested. They're investing maybe not only money but skill set. They're investing some emotion because you really have a partner there that you want to be able to rely on when things are good, maybe when things are bad. But if things go sideways, you want to know like we are in this together. And by Dan Martell, he always says the transformation happens at the transaction, right? You don't learn a lot if you're not putting money up or you're not investing, whether it's your time or your energy, if you are not actually stepping up to the plate and saying, "Hey, this is a part of me. This is what I believe in. I'm going to give this to you and trust that we're going to do something amazing together." That typically doesn't happen if somebody isn't fully invested.
I agree. And I subscribe to that philosophy. So I completely agree with that.
Right on. No, I love what you're doing. There's got to be a deal that you're super proud of that you just absolutely, maybe it's the first deal, maybe it was the second deal, maybe it's the deal you're working on right now. But what was one of the best deals that you think you've ever made?
I don't think I've had, I believe all the deals, all of the properties that I have bought, I'm very fortunate that they're all doing well in different at different levels. But there's one in particular that I purchased, that the rents were probably at a third of what the market was at. And I couldn't decide how I was going to reposition the building because you had individuals that had been living there for 10, 15, 20 years, and they never called the landlord, and the landlord never called them because they didn't want to call in any attention to the rental rate. And now here we are, and we need to reposition this building to accomplish what we thought we were going to accomplish. Well, when we bought the building, it had a few vacancies. And typically when I buy a building, if there's a vacancy, I love that. I prefer month to month tenants and vacancies because we could go in, renovate a unit, and show them what could be possible.
Mm.
So when we got there, like any transition and in any business or in anything, when we show up, there's a new person in town and people are upset and a few people left. But then those that stayed started seeing what we did. And if you're familiar with this game, Tetris,
Yeah, very
that is
much.
basically what we did in that building. So we offered it at a little bit below market so that they would stay, which benefited us because if we didn't have it vacant for 60 days and somebody moved right over and we can renovate the next building, the next apartment, excuse me, somebody would say yes, they would move in, they would sign a 1-year lease, and then we would renovate the next one, and we would renovate the next one, and about 70% of the residents stayed.
Mm. Those are good numbers.
Which is incredible because they were paying about an triple what they were paying before in rents,
Yeah.
and they still stayed. Now we beautified the building. We did a lot of beautiful things to, we painted it, we put in landscaping, we made it very nice, and then the interiors were beautiful. And so that is one building that I'm very proud of because we were able to keep the residents there and create a really nice building for the community.
If the building it looks really good on paper, right? The performance looks strong, numbers look pretty solid. Are there any things that you would look at immediately that would detract that investment for you? Whether it's going to be something like is it a cracked foundation? Is it there's a swimming pool that is empty and needs massive repairs? Is it I mean, I know you said most of the buildings that you're focusing on are sort of garden apartments, but
Mhm.
is there anything there? Is it a overall small contingency fund in a strata unit? Is it just landscaping that is totally shot, or services, plumbing upgrades that need to be done that are absolutely terrible? Are there any sort of major red flags that, even though it may look good on paper when you're running a pro forma, would stop you from, or really have you second guess whether or not this was going to be a good investment?
So you do it in two layers. You get a beautiful uh, package from the building that shows everything is perfect, and you underwrite based on that and your knowledge.
Mm.
So if you've bought several buildings from that era, you know what to look for and you know where the issues are. So that's the first level of underwriting. And then when you go under, let's say it looks fabulous, this is good, the performance perfect, and then you do your due diligence. During due diligence, you need to absolutely make sure that you have the right contractor, that you have the right plumber, that you have the right roofer and the right electrician, and sometimes even the right engineer, like a structural engineer, to come take a look. People or vendors that you trust, that you've hopefully done business before, or someone that was recommended, that will come and give you their opinion and estimates on what needs to be done, so that you can go back, redo your pro forma, and underwrite for those capital improvements. I've bought buildings where, for example, my plumber will tell me, yes, these pipes are old, because obviously we know when the building was built, but they're in such great shape. I would guess, and obviously it's a guess, that you're not going to have to touch this for 15 years. So, or you're not going to have to touch it for 5 years, or you don't. So what do? You kind of underwrite for a problem or two, so that you can understand and make sure that you have it in the cash flow. So it's not like a perfect scenario where you can say, here are the things and here are the boxes that you could check. You need to have the checklist of all the things.
This episode is sponsored by New Vision Projects, and everybody has heard the horror stories that happen. They have a friend of a friend or a neighbor that's been renovating for years on end, or they've been building a home and it just hasn't gone the way that it needed to go. Budgets are blown through the roof, timelines, forget about them. New Vision Projects has an incredibly strong track record for over 15 years of working with customers, serving them at the highest level. If you are considering building or renovating, check them out on Instagram at New Vision Projects or at newvisionprojects.com. Building the homes you want with the confidence you need. New Vision has you covered. Let them show you why they're different. Back to the show.
And then it's almost like a menu that you pick from based on what the asset is like. So it has to be in levels.
I think it's important to know that it's not just about the investment, but it is like you're really relying on good people, right? And that network of people that you can trust. You mentioned, plumbers, electricians, builder, engineer, the dream team essentially that is going to come together and actually help you define whether or not this is a good investment, or if it's just going to be a massive risk, massive headache. And I think that's something that people really tend to undervalue, because a lot of time people don't actually know what it is that they're looking for. So they need to bring in people to help them understand what it is that they should be looking for.
And be involved, because when my plumber, for example, comes out, I learn something new, every time you be involved and ask questions and look, because they'll explain things to me. If you're with the right professionals, they don't mind explaining things to you, and they'll explain to me, or they'll send me pictures, or they'll say, you really want to come out here because I want to show you this specifically so you can understand what this is. And if you treat your vendors properly and you pay them fast, they will perform for you.
Yeah.
And I've been very fortunate in that regard. I mean, I am very lucky that if I even have an emergency, a real emergency on a weekend, no matter the time, they will come out. I'm that fortunate. But because of the relationship, because and I want to say something else, but because we pay them quickly, because we treat them right. But that doesn't mean that you don't check the pricing. I want to be very clear on that. Like, you do have to do your due diligence and understand what the market is at. But if your vendors are smart and they see the volume that you're going to give them, they usually treat you right.
Well, there's some leverage there, right? I'm in the construction industry, and we know that our trade partners that we will typically use, they know that there's an expectation that there's going to be more work coming down the pipeline. So if they need to go
Exactly.
out of their way to come in on the weekend or do the thing or help us move mountains to get a client in sooner to their home, like, they're going to do that, right? They're really going to step up. It very much is relational based, and relationships in any business. And you know, we're talking about investing in real estate, but we've established a number of relationships that if you're looking to invest into real estate, you should start making, right? It's
Yes.
not only just the operator, the active operator of the unit if you're deciding to passively invest, but if you are looking to actively invest, it's the real estate agent, it's the probably the mortgage broker that's going to get the deal, it's the underwriters, and on top of that, sort of below that, the paperwork side of things, it's going to be the engineer, the builder, the tradespeople that are going to come in, the landscapers, the painters. There's a huge ecosystem there that you can build, but once that's established, you can really begin to leverage, and they become a foundational part of your team. And that inherently would make investing that much easier once that team is established, because you have that confidence of everybody else and all these professionals behind you that are going to help guide you and guide you away from potentially bad decisions that you might make.
And I'm going to add one more. Make sure you have relationships with the residents too. Because as your portfolio grows, I have a building that's all studios. And when they outgrow their studios, they call to see if we have a building with a 1-bedroom or a 2-bedroom or whatever it is before they go out looking to the market. And it's because of the relationships. So we
I
get
love
to
that.
keep our residents in our ecosystem, and in our world, if you will, because they know already what type of landlords and how we operate. So that's a
And
part of it as well.
you also mentioned something that I thought was interesting is you prefer month to month, because if you have long-term tenants, and people would often see, if you have long-term tenants, that's a real value add. But certainly here in Canada, if there's real tenancy laws in place, and if you want to do any sort of improvements, it can be very difficult to ask people to leave. Whereas you mentioned the month to month is actually a really, that's actually your preference, because it makes the flexibility of doing updates and renovating that much more simpler.
In Florida, it's not as, I don't know how Canada is, but it's not like many of the other states, like California or New York or Chicago that you hear. So Florida is a little different. And the flexibility of having a month to month, because if there's someone that's living in like really deplorable conditions, we want to get in there right away and fix the unit and offer them another unit and be able to move them. But if we're tied to a lease and they don't want to transition, which could happen as well, then we can't move forward with our action plan.
Before we head out, for somebody that's interested in finding out more about you, finding out more about investing in real estate, and somebody that's just like, I know this is for me, I know this is something that I want to do, I don't know where to get started, I've been researching, I know that this is a great asset class, where would you tell that person to start? How does somebody start getting involved in multifamily if they're ready?
Well, I will say that if any of your listeners are interested in investing in multifamily, specifically in the South Florida area, it would be my pleasure to have a conversation with anyone that wants to get started. either passively or actively. There's nothing that gives me more joy than having people getting involved investing in real estate, because I believe that that is the path to wealth. So reach out to me on Instagram. Nat Falcone is so it's N-A-T Falconi. And so reach out to me, and if I'd love to share any insight that I have or answer any questions. It would be my absolute pleasure.
I love it. Yeah. Make sure you go follow her. She puts out a lot of information, a lot of education on this. And I think you're just a superhero and an encourager of those that want to go and learn about real estate. And I think you're doing a lot for the community, a lot for the industry. And I really respect that.
Thank you so much. I loved our conversation, Brandon. And hopefully we'll encourage some of your listeners to get involved and start looking into investing and expanding their investment portfolio and including real estate in that.
Let's go. And anybody that is really on the edge and just edge of making that first big investment and they want to nudge to get off there, I mean, find the right people. You don't necessarily need to know how you're going to do it, but as long as you find the right people,
yes,
and you understand who can get you down that path and help guide you, that's going to be something that's going to be really, really powerful.
Absolutely.
Nat, thank you so much for being here with us today. I really appreciated your time.
Thank you so much. Have a great day.
Yeah, awesome. And to all our listeners out there that are still with us, until next time, I'm here rooting for you to win. Have a great day, everybody. We'll see you next time. Rock and roll. Stay blessed. See ya.